percentage or just more the same?
I don't know how unemployment can go lower. I mean, I'm not the professor of economics like your last guy, but how is this even possible that we're floating in this range?
That was my point, right?
Right, I know. I figure that's where you're going with this.
Full employment like 2016, but
right.
Yet keeps going lower.
And now we're 2 points lower than that. Listen, the markets are doing really good. You know this. The markets are doing really good. The economy is doing really well right now. Unemployment's very, very low. Interest rates are low. Everything's Goldilocks right now. And when we hit this type of cycle, this is when you got to ride it out. Like, this is the late 90s all over again. You ride it out as long as you can. But two, you got to look for the next bubble, and you got to be cognizant of what can burst this. You know, the trade war thing has kind of died away. A lot of the political fallout going on out in the economy right now that could have affected has gone away. Yeah. So what can affect us in the future? You know, and besides that, ride out the wave and enjoy the 26% returns you've seen in the last 4 or 5 months.
So this is kind of the don't fight the Fed argument in some sense, which is if they're not going to be the disruptive force, then what is? And it doesn't, there's nothing that's really screamingly obvious right now, I guess.
The only thing that I think is screamingly obvious is that the U.S. government debt is out of control, and no one's talking about it. Both sides of the aisle basically have ignored it at this point and have no will to go attack it. That is a thing I think 10 years from now we all look back at and say could have derailed things. We're piling debt when we're in the middle of a Goldilocks situation. We're sitting in a time when things are supposed to be roses and we should be at least whittling that away. Earnings are great. Yeah. Companies are making a ton of money, but yet our government is bleeding money out of the backside. So that's what we're worried about. Now, I'm not going to sit here and tell you that we run for the hills from here. We certainly don't put everything in cash and get scared of it, but you got to be more selective in your defense. You're not going to see another 26% return in the next 6 months. It's virtually impossible for that to happen. So what are you doing with your money today to be prepared for the what ifs and still ride out some of the fun parts?
To you, this means in terms of sectors, in terms of stocks, still basically riding technology, the winners that have been doing well in this type of market.
So when you normally talk about technology, you don't think defensive. You don't think this is something that's protecting my portfolio. But if you're looking at a sector when we're looking at sectors, we want what's going to continue to grow. What are you going to use 6 months from now, 6 years from now? Who's making money and who has buckets of cash sitting on the sidelines? And right now, that's the technology sector. You've got your Googles, you've got your Alphabets, you've got your Microsofts, the companies out there right now that have hordes of cash. So things, if they do go sideways or get out of this Goldilocks period that we're at right now, they can ride out that wave way better than a lot of the companies out there like the Teslas that bleed through cash, and will have a problem if they're losing money today. What happens 2 years from now when things aren't as nice?
Do you think we're starting to see a little bit of discrepancy by the market in terms of Tesla trading at the very low end of its range for 2 years, Lyft getting pummeled after a debut of a cash bleeding company?
Pummeled, they should get pummeled. And Tesla, 2 years ago I was on TV talking about how at the time it was at its high, you should be running away from it, pounding the table on them, still pounding the table on it. Companies that can't make money in this environment have a problem.
What about these stocks that continue to basically make new highs? I'm thinking the software as a service, the cloud stuff. Do they have a catalyst in this morning's news in that they derive their business from other businesses that want to be more efficient, that want to spend on their tech? Is that going to be able to drive valuations higher? I mean, are these the type of companies where you can kind of put valuations to the side because they're generating cash flow?
Okay. You can't put it completely to the side, all right? But that's part of the art form here. You've got your Amazons of the world that have tons of cash, and their valuations are pretty high right now. Right. But you're going to use it more a year from now. I'm going to use it more a year from now. And so that's what you're pricing into it. But then you've got, again, when you're looking at, you have to be selective. You can't just go broad-based sector like you were showing on your charts here anymore. You could for the last few months because you're playing off the December lows and you're just riding that wave. But now, if you're going to be in technology for what we're arguing about or talking about right now, find the companies that are profitable, that have good cash flows and are reasonably valued, so that way if things aren't as perfect as they are today, they'll still make you money in your portfolio for the moving forward.
I think this is a really important aspect of what's happened here, because when Powell pivoted, the market just had this springboard basically that it's always had. And so far that has worked in an incredible way. We're back near the highs. The question is, does it keep working like it did in, say, 2016 after we had that pocket of weakness, recession, a couple corrections? We bounced back to the highs, and then we kept on rolling.
Well, 16 going into 17 was a little different too, because you had the tax bill that was inflating what everyone thought everyone's earnings were going to be. So you had that jump. And then what's happened this year is because everyone in December thought the markets were going to get crushed because of the trade war was going to be terrible, and people at the time at least thought interest rates were going to spike.
Right.
And then they've done a 180 on that, and I don't think it's going to drop from here. I mean, how can you make the argument that we should cut rates when things are going as smoothly as they are right now? It's one thing 3 months ago when people were overreacting, but rates are going to stay the same where they're at. Maybe they go up a year from now. I can't see an environment where we're talking about more cuts. So that's not going to artificially inflate the prices anymore.
Okay.
You know, now you're going back to, like I was saying in the beginning, true earnings, true cash flow, companies that are actually making money and are in sectors that you believe are going to continue to grow in the next 5 years.
Yeah. I also, when you look at the earnings situation, it hasn't changed basically.
No.
You know, we've gone from a negative expectation for the quarter to a positive number, and that's fine. The guidance has not picked up. The chart we're showing at the top of the show, I think, is one of the most important ones, because what we've had here, this basically shows us, I know it's not exactly the coolest looking chart in the world, but it basically says all the revisions to the downside stopped.
Yeah.
That's a good thing, but it doesn't mean that anything's picked up. So what we've had is pure multiple expansion. Your point is that multiple expansion may have run its course?
The things that were artificially pushing it up are done. Okay, now you're back to just pure growth again. Okay. Can it grow from here? I like the fact that we're not at crazy high valuations. That's a good thing when you're talking about real risk return right now. We're at more reasonable numbers than we were, say, a year ago. But do you think that earnings are going to dramatically jump another 20%? Do you think revisions are going to go up through the roof in the next quarter? I mean, I don't. It's hard to imagine a scenario where that takes place, barring some outside intervention like a rate cut or another tax bill, which both are not going to happen.
Yeah. All right. To your point about the immediate risks and how to gauge those, one of the companies that you like, Micron, the semiconductors have been a really interesting place. And you might know where I'm going with this, because I do think one of the risks out there is that we don't have a lot of visibility into the efficacy of this last round sort of China stimulus. So far, it looks like it's going like a charm. Data's gotten better. But a company like Micron seems so hinged to that, as opposed to like one of these software companies here where as long as the U.S. is good, they're good.
Okay.
Micron needs the rest of the world.
I put that in there because it's kind of the other side of the coin. We're talking about growth, you know. Meanwhile, you got Micron. Its valuation is cheaper than a bad utility company right now. It's a more of a bet. Okay, it's more of a risk bet. You're playing off the fact that you think not the economy, but the markets have undercut its price just too much, and you're buying in at a deep discount. You're playing the contrarian view, because you're right. They are hinged on the international market a lot, and who knows exactly what happens in China? I don't think they know what they're going to do from month to month sometimes, but is that a safer bet than, again, like a Tesla or something like that? Yes, I would make that bet over and over again.
I got one more for you real quick before I let you go.
Of course.
In terms of the effect of policy on markets, you know, 2016, the election, when we were talking about tax cuts and stuff, betting on that turned out to be a good play. The latest one seems to be infrastructure, but this has duped people so many times before. They always think there's a bill coming, and it never really happens. Is there potential for that to be another piece of stimulus?
I think you kind of nailed it. They've been talking about that for a long time. Who's going to pay for that? They're talking about, what is it, $2 trillion, whatever crazy number they're throwing out there. I mean, again, it's politics, so there's not a lot of logic and reason that sometimes gets factored into those. Am I going to sit there and say that I'm 100% behind that there's going to be an infrastructure bill and these companies are going to make money because of it? That's iffy. That really is iffy right now. If it happens, it's going to be clear-cut winners, sure.
Transports.
Transports. Exactly. All the ones the same ones we were probably talking about 2 years ago about the same exact thing. I don't like to make bets on politics, though. And right now, I just don't see how this is more than just some people trying to grandstand a little bit and make their name known that they want to raise money for these purposes. Don't get me wrong. We need new bridges. We need new roads. There's no doubt about it. But you have to be realistic on how you're going to go about paying for it.